My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the rough hour is Ophir Gottlieb, who is well known in the vol option space. Ophir, introduce yourself to the audience. Who are you? What's your background? How'd you get involved in financial markets, in options, and vol trading? And what are you doing currently?
Yeah, thanks, Michael. Thanks for the introduction. Sure, I've been in professional finance since 1998. Started as a financial advisor, which back then was called a broker at a firm called Payne Weber, which is now UBS. Then kind of fast forward through my career, a couple of graduate degrees. And then I was a option market maker on NYC Arca and SIBO, hedge fund manager, managing director of quantitative research for a couple of institutions. And now since, 2014, I've been running Capital Market Laboratories, which is a boutique research and financial technology shop. So on one side, we're doing stock research, and then the other side, we're doing financial technology surrounding options trading, volatility trading, back testing, and similar. So background in quantitative economics, mathematics, obviously finance, and various subjects surrounding all of that. That's probably my not very good elevator pitch.
How important is being good at math to options trading? Because from the things I see on FinTwit, there's a lot of people that YOLO into options that don't really understand the numbers behind the contract.
Yeah. So I think there's mathematics and there's arithmetic. I think it's good. I think it's important that you're good at arithmetic. I don't think you have to be, I don't think you have to go to Stanford for a graduate degree in math to trade options. That's a little overkill, which is what I did, but I don't need to trade options. I do think you need to have good arithmetic. And it's kind of a mantra. Mantra matter. One thing I say to people who get started in options is this is just the truth. And maybe half the listeners are just going to drop off, but this is, if you want the truth about option trading, this is it. Option trading is volatility trading, whether you mean it to be or not. So even if you're like, no, I don't trade vol, you do. If you're trading options, you can make more money if you're looking at volatility, or most likely you can stop losing as much money if you start looking at vol. So you're going to say, I don't care about vol. I care about direction. It's really nice to hear. That's great to hear. You're trading volatility, so you better know. And the second mantra I have for option trading, which is why arithmetic matters, right? Not necessarily math, but arithmetic, is that you can only hedge an option with another option. You can't hedge an option with stock. And I can give a perfect example of that. If you're like, everyone will say, oh, that's true. And so as long as you understand those principles and can do arithmetic, that's good enough. If you want to start creating vol models, okay. So then maybe at some point, maybe mathematics next, but be good at arithmetic, understand the asset that you're trading, and just don't be lazy. If you're lazy, you're just paying me. You're paying all of the professional option traders out there. We're looking for you. We're looking for people who don't realize they're trading volatility. Just come on. I have an endless appetite and the fact. I've never made this.
So, and I love that framework. Like, options trading is vol trading at the core. Now, I was going to ask a question, but I'm going to do derivative of that. Pun intended. I was going to ask originally, so 1998, you get involved in the option side. How has the option market changed? But a part of that is also how volatility has changed with central bank intervention. So talk through sort of the evolution of options, the evolution of volatility, if anything has altered over the years because of the extent of central bank intervention.
Yeah. So two-part question, both really good questions. So how has the market changed? I can just say structurally it's changed in the sense that, like, when I first started trading options in 97, 98, things are trading in fractions. Electronic trading wasn't so ubiquitous. Certainly the number of strikes and the number of expirations, there's no such thing as a weekly option, certainly not for single names. And then we've just had this sort of explosion of access to data, like having vol data, unless you had your own model, was not so easy to get. You could, like I said, you could use arithmetic and start looking at an options chain. So it's just changed dramatically. The access to tools, the number of strikes and expirations, that's just structurally it's changed. The market has always is a big word. I have a saying, never say never and always, unless you're saying never to say never and always. So I won't say always. In general, what I've seen in the options market since it kind of began with Black-Scholes and Merton, we moved through vol regimes. All right. So that sort of there's like a low vol regime, a high vol regime, a volatile vol regime, a stable vol regime. These things have always happened. And then the reason for them, they always seem to change, right? Today is always the most important day of our lives, right? Like whatever's happening in the news, even aside from finance, like it's the biggest thing in the world, right? And then we tend to forget, we have this bias, we forget about what happened 10 years ago. So monetary policy has only been a part of well, let's say shocking monetary policy has only been a part of options trading in bursts, right? So Alan Greenspan through the internet bubble was really, rates were rising. It was known that they were rising. We would get out of these FOMC meetings and the market would go up on a small rate hike. It was really bizarre. It was the internet bubble. And then, everything came to roost, right? The most sort of violent or abrupt event that has happened in my options career, and I imagine for you probably and many of your listeners, was the financial crisis. I was making markets on the day that the SEC on a Friday, on expirations Friday, said it is illegal to short banks. Well, what do you do when you're a market maker and you have, 35,000 different positions? And you're like, well, my options, I don't even know where my options are going to expire. I know that I'm delta neutral in general. I'm not delta neutral in the front month. Like, I don't fucking know. And then it's like, yeah, you're basically creating in 3 hours, you're committing a federal crime. It's like, what the fuck is going on? So monetary policy, Fed policy, in this case, SEC policy was just abruptly like in your face. That was the most violent irritant I had ever seen. And then monetary policy to follow the Great Recession obviously had a great impact. We saw this, this wild vol. I mean, an 80 VIX, like it was absolutely unthinkable, right? It's absolutely unthinkable that VIX could even hit that number. And then as we got through the sort of the Haynes bottom in 2009, and then vol started trickling down, and monetary policy with, ZERP and almost of it, TARP. You remember? There was TARP and TARP 2. They even had to rename TARP, if you remember that, Michael, right? It used to be called the Toxic Asset Repurchase Program. And they're like, oh, that's not gonna pass in Congress. And it didn't pass in Congress. We have to call it the Troubled Asset Repurchase Program. So I consider that all monetary policy. And that had profound effects on options trading. It made a period where selling vol was so good to a period where you really had to very quickly understand, without necessarily a lot of experience in it. Certainly at my age at that time, I'd only been in the business for, what would that be? 10 years. Like now there's this thing hanging over our head called monetary policy and ZERP and these repurchase programs, which violently changed how you had to change options. I was an option seller. I was a premium seller. I was short Vega, short Gamma, hedged with options, but that was my position. And then that doesn't work. That didn't work. And that was because of monetary policy. It was also because of a recession. And then we fast forward today, right? Like, what happened? I don't think it was just monetary policy, by the way. I think it was also fiscal policy when COVID hit. I mean, everybody remembers 2020, right? Think of, April 15th onwards in 2020. What happened was profound. You could kind of just throw volatility out the window. Just as long as you were spreading, you were fine. You didn't even have to measure absolute values because everything was going up. It was like, how are you going to make money on it going up? Don't buy naked calls. So monetary policy violently changed the markets. In this case, monetary and fiscal policy violently changed vol regimes twice in my career. Really substantial, had to alter the way I traded and to recognize quickly that we were in a new regime. So those were the two sort of shocking things that happened in my career. And now we're kind of at the tail end or the beginning of the effects.
Yeah. And actually, that point about access to tools kind of relates to your point about, laziness and in the options side. As technology has made it easier for people to trade options, I'm going to make the assumption that it's almost been easier to be a professional options trader because there's so many more amateurs that are playing in a fairly complex space.
I would say generally, yes. I think Robinhood, I don't blame I don't have the sort of axe to grind with Robinhood. I do think that as a brokerage, like the number one rule for the brokerage, other than don't get sued, is like know your customer, KYC. And they're like DKYC, like don't know your customer. And so that, alteration to what was happening in options made it easier in some regards to find. So, okay, as an option trader, you're kind of like, what am I trading today? What are my positions? What am I trading today and why? Right? What's my plan? I found more and more opportunities because of that. So my list of trades in a day went from, maybe I'm looking at 3 to 5 ideas. And I was looking at 20 to 25 ideas, like it was too many. So there was a lot of money to be made if you just knew what you were doing. So I agree with that premise. I don't really know what it means moving forward. Right? Okay, so we're past that, right? Are there more option traders in there? Is there more money to be made? I know that if I was on the floor and we were getting retail flow, we would have just, open outcry is not what it looks like in movies. It's really calm. I'll bet you it wasn't calm during that period. I'll bet you people were getting in fights again, like fighting over that 25 lot from retail because that was just free money. That's my guess. I wasn't on the floor. But yeah, I mean, people who are YOLOing, that's fine. I mean, to each their own. And I never root against anyone, except that I always root for myself when I'm trading. So if I'm trading whoever I'm trading against, I want your money. And it was easier to make money during that period. But it might have been easier to make money because everything was going up. Right? So I don't know.
But I do wonder if just because of, again, going back to the number of new entrants and you see the volume of 0 DTE, the notional leverage is, keeps on going higher and higher. And if the precursor to high volatility is high leverage, I do wonder if the structure of the options market lends itself to more of these kind of tail risks.
It does. I think it does, but I'm not. So this is where I had this sort of revelation, which you may violently disagree with, but in probably around 2011, I was getting off the floor. I was back in research. I had this idea, and this is going to sound almost esoteric. Hopefully it sounds nuanced and not esoteric, but whatever. I used to think that the option market priced risk. Right? You look at at the money straddle the day before earnings, they say the option market is pricing an 11% move in this company, whatever. And then I changed my vernacular to say, it doesn't price the risk, it reflects the risk. And I know that sounds like a triviality, but once I realized that the dog is the equity market and the tail is the option market, and the tail does not wag the dog, even though it seems like it does. That was a radical change in my trading philosophy, and I started making a lot more money. And the only way I could get there was after years on the options on the floor, making markets, where I realized, yeah, man, I am experiencing the market through my market making. I'm not influencing the market, and nor are the positions that are being taken. I don't mean that in like absolute terms, but that has changed it for me. So I believe the option market is reflecting things, and the thing that it's reflecting is because of equity risk. Now, what is equity risk coming from? Well, a lot of that now is monetary policy, or economic data, economic realities. But this is going to sound weird. I've taken a step back from sort of the King Kong, king of the hill, options are the smartest people. Yeah, I don't know about that anymore. And I used to be one of those guys. I've actually backed off that, and it's helped me make more money.
Speaking about volatility and, current market dynamics, I'm curious to hear your thoughts on how, when you have these periods of concentrated mega cap momentum, how that could impact volatility, and then as such, obviously options trading, right? I mean, I made this point many times before. You're now getting to a juncture where, the S&P, the NASDAQ, it's not really a diversified index. It's basically,
seven companies.
Yeah, it's idiosyncratic risk, right? It's not obviously there's more participation more lately, right? But you're getting to a point where the volatility dynamics are not because of pure beta, but because of company specific risk, right? It's like I even dramatically put out that tweet saying a little bit earlier, saying Nvidia can take down the entire fucking stock market, and I'm saying that in partially in jest, but I do think actually there's a possibility there because it could cause a kind of a butterfly effect if Nvidia breaks, and then all the leverage around the Qs and everything kind of breaks. So just talk about how you think about volatility and risk when you're in an environment where there's almost like two different markets, right? Underneath.
Yeah, it's really interesting. So I know you published a paper on like historically when the VIX is super high, just irrespective of what's going on in the world, it's probably time to get long equities long term, and kind of vice versa. It was a super interesting paper.
It was basically just buy low, sell high. I mean, and certain sectors get very divergent, right, during high VIX levels. So there's an opportunity there.
That's right. And now we're in, sort of the spirit of your question, which is reality, is like, well, has VIX changed in and of itself, right? Because of this extraordinary market cap concentration. I think it has. I don't think things change. All things change. I just think that the regimes or behaviors change inside of them. So I think I definitely agree that there is clearly lopsided risk in a relatively small number of companies that could move what we're broadly calling the market much more violently than it would have, say, in 2016, right? And Nvidia, Tesla, Apple, Google, we know the seven, right? And then the ones which are kind of have this kind of histrionics type of moves, right? Which would kind of at this point would be kind of Nvidia and Tesla. So it makes it so that index type of trades for me have gone down, and individual names outside of that have gone up. So I'm looking for good skew opportunities, but I'm kind of intentionally ignoring mega cap. Like I pretend that whole layer of the market doesn't exist for me because I don't want to argue with the market. I don't feel strongly enough to make a speculation such that I want to put any kind of size on it on that part of the market. I'm fully aware of the impact that those megas will have on the smaller guys. You have to be. But the opportunities to me now are there individual names where skew isn't quite what I don't want to say right, but where I think there's an opportunity and where am I hunting for that? So how has it changed me? I've become very individual name focused outside of the megas and far less VIX, SPX, Q focused, far less.
Okay. So on the individual name side, do you tend to find that when there's some really interesting plays there that they tend to be focused on certain industries, certain sectors, kind of the argument of a school of fish and skew is kind of consistent across the board, or are there kind of more idiosyncratic aspects to it?
Yeah. So idiosyncrasies are it's hard for them to be reflected right now, but there are still some. So if you go stock by stock, let's say I'm generally in tech and not, kind of cutting out option trading in mega tech. So maybe let's call it mid tech, right? And mid market cap that's a much bigger number than it used to be. Then names inside them in sub industries, you can find names. Or let's say I'm bullish. I'll just make it simple because nobody likes to talk about being bearish. So let's say I'm bullish, but I'm not particularly interested in getting like naked long vol. I just or just naked long options in general. So like, how am I spreading? Well, then you start looking and say like, are there idiosyncrasies in the skew of this company where let's say there's just been a lot of volume in some out of the money calls. Those are getting bid, not on a day, just let's say it's been continuous, a week or 2 weeks. There's this continuous flow, not psychotic flow, not meme stock flow, there's just flow. And you say, okay, those out of the money calls, let's say the 30 deltas, I'm just making up a number, like they're just too bid if I can come back to at the monies and buy that vol and spread it off on that. And so that's a lot of what I'm doing. Not always long. It's also to hedge or to get short, but that's where the opportunities exist. It's much harder to find those idiosyncrasies in a period like this, much harder because things tend to move together, but they do exist. It's not impossible. There are individual names which are having news and which are having flow. And so that's like my process is basically that. I'm back testing volatility ideas, looking for opportunities in differences either in strikes and expirations, right? Moving across time. And that has really never stopped I'm going to put air quotes up here. Like it's never really stopped working, just become a little bit harder.
The co-movement point I think is interesting because, there's a lot of arguments that with the advent of ETFs, everything is kind of co-moved tighter in general.
Yeah.
Right. So I got to assume that's also been an interesting structural change from an options perspective to try to find those individual names because to your point, it has nothing to do so much with the company demand and more with the ETF demand.
Yeah. So that it's really, and I think it's partially that. I think it's partially this hyper focus on monetary policy, this hyper focus in the mega caps. It's a lot of things are becoming concentrated, right? It's not just a thing, but what it leads to is great, like this movement that's overly systematic and not idiosyncratic enough. But I mean, there still are idiosyncratic stories. There just are. And they don't have to be like Carvana. Like there are real companies that have real stories where there is option trading going on and there are idiosyncrasies and there is fairly good liquidity and you can trade that and make money. And that's what I'm doing. But I will tell you, it's much harder. So when I mean by harder is, let's say I have 10 ideas on my screen. Maybe I would normally take 2 of them. I can go a whole week and take none of them now. Because like, it's just not enough. Like I'm not going to force it. I don't see enough edge in that skew differential that I want to take the trade. So I'm sitting on my hands more, which also means I'm going a little bit bigger when I find an opportunity, right? Because I want to move a certain amount of capital in and out. And so that has been the biggest change to me. But yes, I think there's a lot. We could have an entire 3-hour spaces on what has caused this kind of mush of movement as opposed in the systematic movement rather than idiosyncratic movement. But I really believe, there still are opportunities. It's just harder to find. That's all.
And obviously, I'm with you on that. It's like, it's also just passive automatic flows coming in, creating a constant bid underneath the surface of kind of the large cap averages. All that stuff has been in play for a while. But so that becomes then interesting because the markets, again, tend to co-move in low vol regimes. They tend to be going back to that research mention I put out, they tend to have more divergent type of movements when vol is elevated. So let's take a step back and kind of go further out here. What are your thoughts on just the broader economic macro environments? I've mentioned the credit risk point many times over, spreads stay tight. I'm going to assume that tight spreads maybe are not as interesting if you're going to be an options vol trader because it's a link between spreads and VIX. But how do you think through conditions favoring maybe higher volatility and more interesting options opportunities?
Yeah, I think so. I would say broadly speaking, I think there's more, I don't think this is a controversial statement. I think there's more downside risk in the equity market due to the economy than there is upside potential. Just, I'm going to say it very kind of softly, right? Like there's more downside risk than upside potential, right? So I would say I feel in the short to medium term, relatively more bearish than bullish. I think that, when you look across like what credit events could occur, what could break these credit spreads, a lot of it is coming from, I wonder if you agree with this. I'm getting a sense that there's this sort of waiting for the impact of monetary policy to have kind of this like moment. And it almost felt like we had the moment with SVB and the other, community banks, whatever. And that wasn't it. So when or if that happens and that sort of that downside risk is realized, kind of we've risen very sharply. There's a bit of malaise. Retail optimism is at levels not seen since, various bubbles. It does feel like it's going to break, and that's going to give that spreads will widen. We're going to start to get this idiosyncratic risk, sort of these opportunities increasing, but I can't. So roughly speaking, I think there's more downside risk right now than upside potential in the medium to short term. And then to what degree, I don't know, we could, it's a very big argument. But broadly speaking, I feel pretty confident about that. But I'm very careful, having done this for so long, I'm very careful not to wait for the thing that I'm waiting for and just to trade what I see in front of me, right? Am I aware of it? Of course. Do I see it structurally? Yeah, absolutely. Does it mean I shouldn't trade until that thing happens? No, it doesn't. I need to keep trading. And maybe I'm changing size or I'm taking few opportunities, so I'm trying really not to get, I hate the saying, but it's a good saying, paralysis by analysis. Macro can really paralyze you. And I'm trying not to get there. You know what I mean? Like, does that mean that therefore I'm deaf, dumb, and blind?
No, you're hitting on something which is a frustration of mine. It's like, I myself believe we're still in a bear market. I know it sounds crazy, right? But I have my reasons based on the interaction of treasuries to equities and that lag response, the drawdown interaction. Yeah, I think the difference between a professional like you and an amateur is that when they look at the options market and they see the bear porn that's out there, their response is, well, let me just put a put out there. Let me make a directional bet. But to your point, the macro is not necessarily a timing tool.
No, that's absolutely right. It just, look, so every time someone speaks about their trading system or their predilections, it becomes quite personal. And you say, okay, well, I've gone from objective to subjective. So I'm going to say something subjective, but I think it's a valuable tool. It took me a long time to do this. And it sounds so trite, but it's just so true. Like, just trade. So be very mindful of the world. And then when you're trading, in a certain sense, you've got that, it's like a cloud over your head, or maybe it's sun over your head. I don't mean to be pessimistic. And then discard it for a little bit and then trade. As opposed to letting the sun or the clouds, like you were like, it's going to rain, or the sun's going to come out. And you have to be able to move or you're going to get stuck. So for example, where you're saying you're putting out research, you're talking about the dynamics that could indicate maybe we're still in a bear market or a new bear market will begin. It doesn't actually matter, that there's more downside risk than upside opportunity, let's say broadly. But for traders, we have to move, right? We can't just wait. Macro is not a timing mechanism. And so it used to be very difficult for me. I would get, especially when I started making markets, a lot of paralysis by analysis. I was offering liquid markets, fine, but I wasn't able to really prop trade. I always thought there was a thing. And keep in mind, it was during the great financial crisis. So I had a real big cloud over my head. And I didn't really start making money until I stopped doing that. You got to stop.
Yeah, no, I 100% agree. That's why I use that line, path matters more than prediction. I mean, what drives me insane about all these, FinTwit gurus is they talk, very bullishly or very bearishly about an endpoint that they could be right on. But to your point, right, you can't time it, based on the analysis. You have to have something to tell you something about path potential, right? And it goes back to volatility.
Oh, completely. I mean, I remember when it was apparent to me, which it could have just been luck, but when it was apparent to me, let's say end of April of 2020, right? So the beginning of COVID, then the monetary and fiscal policy, the whole kind of shift in the world. There were a lot of bearish notes out there. And that was okay because some of the things that were happening like there was intellect in what was being said, right? Like this fiscal policy, and that was just one of them, it's going to cause inflation, right? And that's right. And like, hey, when the Fed just cuts rates to zero and starts ballooning its balance sheet, like that's not a sign of a strong economic condition. These are all true. But at the same time, you have to be like, so like you said, path matters. And maybe the end point is right or was right. I suppose it was right if we look where we are now or where we were in 2022. But like, to me, the path was very clearly up in the short to medium term. And that was all I really had to focus on. Right. So that was the path. Was it high IQ what was being said? I think a lot of it was high IQ, certainly from economists and CFAs who are seasoned right now. I mean, there's obviously a lot of bullshit on Twitter. There's people, I don't think they're trying to trick you. They're just not very smart. But path matters. And if you're trading options in particular, you're likely trading shorter term. Short term, I mean, a week or 6 months. I don't know. Like the path matters. And you gotta focus on that path, man, because otherwise you're paralyzed or you lose a lot of money. How many people were dead on about fiscal policy creating inflation? 100% right. And lost their asses. A lot. Or alternatively, how many people were extraordinarily bullish in 2022 because of what mega caps had done in 2021, and they lost their ass because of the bear market? Like, you just be flexible, understand vol regimes, and just try to. It sounds so fucking trite. Just trade what's in front of you, man. You just have to.
Just to reset the room for the remaining 20 minutes. Everybody, please make sure you follow Ophir here on Twitter. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcast under Lead Lag Live. Since you mentioned time frame, do you have sort of a sweet spot in terms of expiration of options that you typically trade for yourself? Or there's a lot of excitement around zero DTE and falling around zero DTE. I have to tell you, I am very skeptical of all these supposed zero DTE trade killers that seem to be out there on FinTwit, because intraday trading is known to not make money, for stocks, right? And now you're putting leverage on options, so it's like it's a losing game, just even worse with zero DTE. I'd argue. I don't have any data to back it up, but just talk about from your perspective that time frame aspect, because I have to assume there's this kind of interesting balance between how long you want to push the expiration out versus volatility, which is maybe more observable in the short to intermediate term than long term.
I completely agree with that. So my longer term option speculations are more delta, right? It's like a directional, long term, multi-year directional bets. In general, most of my option trading is shorter term. So my preferred holding period is, I would say, I'm saying it if stops and limits aren't hit, in which case you got to go shorter, right? But like probably no shorter than a week, and usually no longer than 60 days. And it's for really, Michael, because of what you said. Respect you're in a vol regime and also understand what the characteristics of that vol regime. And if we're in a volatile vol regime, then I don't know if I'm really finding edge in that 60-day option relative to the rest of the skew, or if I'm just wrong. I think you can be wrong and think you have edge. So I would say if you were to look at my books for like the last 10 years, 7 to 30 days are my average. An average isn't a range, but my range of option trade is 7 to 30 days, 7 to 60 days. But when I'm taking longer term speculations, those can really roll for years and years. So leaps and then rolling leaps, and then like you're selling diagonals, either call spreads or put spreads, selling diagonals on ratios and rolling them, right? My trade pattern, my trade plans for longer term bets can be honestly 4 or 5 pages. Like really, if this happens, long plans. But those are relatively unusual, and they're almost always directional. I'm not making a big vol bet over 2 years. I'm not good enough to do that. So my general, like, what is Ophir doing trading today? 7 to 60 days, probably more like 7 to 30 days.
Okay. Now, as is the case with every trader, right? You inevitably have streaks, right? Where you're constantly winning, you're on top of the world, and then constantly losing, which is just devastating to the soul, for lack of a better way of saying it. Talk to me from your experience. What do you do when you're in these, periods where it seems like your option trades are just whipping you around and you're not really making much headway? Do you step back? Do you keep going? I think that part of trading is underappreciated. What do you do when it's just seemingly the odds are just not in your favor?
Yeah, I definitely have a timeout period. It's a really good question. And you're right. It's not sexy. People don't talk about it, but it's like the key to sort of behavioral finance. So if I find myself, I don't usually have like 3 positions on. I might have like 10, 20, 30. So it's not You're not going to lose on all 30. I don't think that's ever happened, but you can definitely get in a streak where like, dude, what I'm doing isn't working. My P&L is going down. It hasn't been a day. It hasn't been a week. It's been 2 weeks. It's been 3 weeks. I do take time out. So I've imposed, if I have 2 down months in a row, which I don't feel I should, right? So like, I feel like that's bad. And using the very broad sense of the word bad, I do take timeouts. I'll take anywhere from 3 trading days, depending on how bad it is, 3 trading days to up to like 3 weeks, where I'll just say, okay, that's it. And then what do I do to turn it around? I'll do very small trades, which are very high probability, which means, they're not big winners if they win, but like to turn it around, I'm generally not trading a strategy, right? So maybe on one side of my book, you can look at him like, man, he's clearly short Vega. He's clearly short Gamma. He's clearly front spread, right? And then you look at the other side of the book, you're like, oh, okay, like this is actually directional. Like this is like, these are bullish. He's long Gamma here. I mean, I'm long Vega here. So it's kind of like being a long short fund with stocks, but kind of with options, long short Vega. And you just, okay, what isn't working? Like just stop that. Also, I will say this, just, you didn't ask, but it happens on winning streaks too. So like, what do you do when you're on a winning streak? You're like, okay, it feels good. I'm winning. This is working. Is this just bullshit? Is this going to continue? Should I get bigger? When I hit enough of a win streak, I have a 3 trade rule. I go full size, right? So let's say I'm just having a good 2 months, 3 months. I'm like, it's in a particular part of the book. Like this part of the book is working. Okay. So I say, okay, I'm going to go normal size. And if I win now, I'm going to go double normal size. And if I win again, I'm going to go triple normal size. And I've never gone quadruple. Then I stop and I'll do it again. So I allow myself to get bigger when it's working, but I don't allow myself to get stupid. And so those are kind of my rules. I actually learned that on the floor. There was a trader in particular, and I won't embarrass him, but that was kind of what he did, because I saw some of his huge winners. Like, how the fuck are you like, that is a gigantic trade. Like, what are you doing? He's like, oh no. He's like, I'm considering this part of a series of 3. So while I've got $1 million at risk, I actually have, 500,000 that just got accumulated from these last 2 trades. I'm not actually risking another $1 million. I'm considering this one large trade. So that's kind of my rule.
Yeah, no, that's an interesting way of framing it. You've got a large following, and so do I. And again, you see all the kind of nonsense that I see on FinTwit. Talk about things that you see that people get right versus things that people get wrong. Because I think, part of these speeches, what I want to try and do is just kind of right the myths that are out there.
That's a really interesting question, Michael. And I really appreciate the ethos of that question, right? Like we could bash everything that's wrong. And you're like, let's not do that. Like what is right? So, okay. Some of the best things I see on FinTwit, I think that we are unraveling some of the better macroeconomic analysis. So I think that's helpful if you're kind of just trying to get your sense of where we are in the world. And then with regard to trading, I've seen it's more bifurcated now, but there is a group of option trading accounts or just people in general that they're just kind of commenting on the trading that are much more thoughtful about vol regimes. Like that, like I said, when we started, option trading is volatility trading. It seems, and this could be, a thought trap, like confirming evidence. I don't know if this is true, but I've only lived in my brain. So this is all I know. I think I'm seeing more of that thoughtfulness about, it's not just like, hey, I'm getting long Apple. I didn't mean to, probably shouldn't have chosen Apple. I'm getting long a stock. It's more like, hey, I'm getting long a stock, the at the monies. It feels like the vol and the at the monies it is underpriced relative to a couple months out when I'm looking at the 30 deltas. It's like, oh, okay, that's a really, win or lose, that's a thoughtful trade. I feel like I'm seeing more of that. But in fairness, Michael, I use the block button and the mute button quite liberally. So the evidence
with you on that too. It's like I don't even know what's real and what's not anymore because I blocked so many people.
Yeah, that's what I mean. So like my subjective experience could be that I'm forcing confirming evidence. So I don't even feel comfortable saying it's getting better or getting worse. I know my stream is, but that's highly curated. So I don't know.
No, I will say, it's like, some people, when they see that, they say, well, you're creating an echo chamber. It's like, no, I just don't want to deal with schmucks, right? Attacking me and not knowing what the hell they're talking about with overconfidence.
Okay. So I read about 100 pages a day. I didn't know this, but when I was like 17 or 18, I learned that I read a little faster than normal people. Again, we all only live in our brains, right? So apparently it's a little bit easier. So, but a part of those 100 pages, I would say 40 of the 100 pages I read a day are not valuable to me. I have to find a way in my brain. Like there's no delete button in the brain, but to kind of do that. And it's no different on social media. So the idea that someone is living in an echo chamber, it's very trite. It can be true, right? We have examples of like when NASA had its, when our shuttle exploded, that was groupthink. Okay, so yes, you can be aware of groupthink. You can be aware of earthquakes. You can be aware of hurricanes. Earthquakes don't happen that commonly. Hurricanes don't happen that commonly. And groupthink, if you're thoughtful, doesn't happen that commonly, that often. It's not an echo chamber. It's a high IQ move to remove the noise that disrupts your thought process so you can lean on your intellect and your experience. And if someone thinks that doing that is not a high IQ move, it is essentially a referendum on their low IQ or low EQ. You want good information, which may or may not agree with you, but you want good information such that you can form your opinions in your trading. You do not want bad information and say, I need it because it's contrary to what I believe. No, a moronic take on anything, on politics, on how to water my flowers, on how to clean my pool, on what to do about toe fungus, on what restaurant I'm going to go to. Bad takes are not helpful. And to remove them from your thought process is a high IQ move. And to argue that it is not a high IQ move is a low IQ statement.
I'm like laughing to myself because I'm 100% with you. You said it so eloquently there. But I feel like that's actually a good transition to speaking about low IQ. Some of the stuff that I've seen you retweet that I'm starting to look into more actively, which is the dumbing down of AI, given what's going on with ChatGPT. I know you want to talk about AI and generative AI, but there's that paper that came out. I know you retweeted that individual who referenced that ChatGPT seems to be getting dumber, which is a word, right? But
it's failing. It's failing for me. It's failing on some code I've written, actually. I couldn't believe.
Yeah. So let's go with this because I think this is actually really fascinating. I think this is actually where it goes back to the point that, any great idea always takes longer and costs a lot more money than people think. Right. And there's always going to be, bumps along the way. But talk about just what you yourself are seeing in that space.
Okay. So broadly speaking, I think what OpenAI has created in ChatGPT, I am willing to say it is a revelation. So I just want to, before I criticize some of the things, like it's a revelation. There's a lot of money, not just in the market, just generally, there's a lot of money to be made if you understand what it's exceptionally good at and equally understand what it is not exceptionally good at. You must be able to do both to gain all of the benefit. That's not just for trading. Okay. So I just want to start really broadly. It's a revelation. It has changed my life and my company's life. I think it's amazing. Okay. Now, there was a paper which came out. I didn't even look at the methodology. It just rang true to me that ChatGPT 4.0, so the newest version, the latest iterations are making it less accurate. And like I said, I didn't look at the methodology in the paper, but I can tell you from code that I've written to the API and things that I'm doing, I'm getting worse results. So I can give a very basic example, which is where even someone's like, I don't really understand what you're saying. So this is an actual example. It's not contrived. I know people are going to try this. In 3.5, if you say the stock ticker is XYZ, tell me the stock ticker. ChatGPT 3.5 will say the stock ticker is XYZ. And you say, okay, the stock ticker is XYZ. Tell me the stock ticker, but only give me the 3 letters of the stock ticker. 3.5 will say the stock ticker is XYZ. It will not say XYZ. It just won't. You go to 4.0 and you do that exercise, and eventually 4.0 just says XYZ. It just gives you what you want. And you can see why that would be relevant if you're leaning on like a random forest and you're trying to build code. That actually stopped working in 4.0 recently. So I haven't based my opinion on that one thing, but it's a really simple example where I was like, what the fuck just happened? It reverted back to bad behavior in 3.5. And I don't know what's happening. I have no insight into what it's learning, how it's being updated, how frequent. I have no insight. But I can tell you that as the end user, it has gotten worse. And that was one small, it's not a trivial example, but it's one of the smaller examples, but it's being reflected in other things, even in code writing. Like some of the code it's writing is like, it's making more mistakes than it was before, it's disappointing and also disruptive.
And what do you think are the implications on that, on sentiment towards AI? So it's not a space I know that much, but I saw somebody say it's kind of the problem that Tesla's come up with the autonomous self-driving. That there's a problem called the last mile problem, which I don't exactly know what that means, but I can kind of guess based on just the term the last mile.
Yeah, that's actually a good enough understanding. So maybe we'll disagree here. I don't think the implications yet are so broad and vast. I think it's a small group of people who are using, maybe I'm wrong. Maybe I'm just totally wrong. I think it's a small group of people that are using GPT-4 for a use case that is so sensitive that this change is so disruptive that in a sense of like, let's say it kind of tears down work, right? Like Like a system was built, a methodology for anything. Doesn't matter. Doesn't have to be stocks. And that it's no longer working. I haven't found that. And OpenAI, I mean, I think they're actively working on this, right? This is not, it's not like a local government makes a decision about a road and you're like, oh, fuck, this is going to be a terrible decision that I'm going to have to live with for 10 years. It's not like that. So I don't think it's that disruptive yet. The potential, I've always felt this, not always. I thought this fairly early on. ChatGPT has basically been trained, forget legal or not legal, has basically learned on the collection of all human knowledge that has been published, right? We call it the internet. And okay, copyright infringement, blah, blah, blah. I don't want to talk about that. But then when we get to, once it's been released, in a certain sense, OpenAI is almost putting itself out of business because more and more content is going to be generated from these tools. And so what is 4.0 or 4.5 going to learn from? Well, it's going to learn from content it put out, right? And that's a very interesting dynamic. It's like, does it start eating itself? And I don't know. So that's the only thing I would worry about. Like if it starts eating itself and what it's eating is less and less accurate, is there like, if you can imagine like a Laffer curve, almost like we've reached peak, like we reached the optimal rate and now we're going down again. I'm not ready to say.
And you think it's the Idiocracy? What's that movie?
Idiocracy.
Right. But on the AI level. Right.
Yeah, kind of. And I'm not ready to say, I just want to be clear. I'm not like staking a claim. I'm just saying it's a really interesting thing because more and more content is being built either directly from GPT 4.0, or let's say, and what we're doing, we're using like several layers of AI and LLMs, but ultimately, like some of it is colored by ChatGPT. So is it learning to get dumber? I don't know. I'm not staking that claim. I think it's a reasonable thing. Like if we had an hour to just shoot the shit over a couple of beers, I think it's a reasonable conversation.
Yeah. And where I'm going with that is, to the extent that manias are driven by fantastical beliefs about a very long-term future happening tomorrow. The viewpoint for me would be, is that enough to break some of the shine on NVIDIA and the AI names, right? That you're kind of breaking the narrative a bit by showing, well, actually, there's going to be there's a lot more nuances to the underlying technology, which makes, the likelihood of these stories not coming true.
It's an interesting intellectual question. So I don't know the answer. The real answer is, if you're going to assign something to be a mania, let's say you're just taking that point of view, then is the mania based on any kind of intellectual argument? Because if it isn't, then no, why would this affect it? It's not based on an intellectual argument anyway. Or are you saying, well, no, there's some underlying core principle that is driving the mania. And if that core principle changes, that narrative changes, then the mania will change. I don't actually know. Like, what are manias built of? Like, you tell me. I know that the mania I saw at the end of 2000, at the end, it was so, I don't know how many people like remember this, but the dot-com bubble didn't end. Like the last thing that puked up wasn't dot-com stocks. It was a very bizarre, it's just a wonderful experience to live through. In April of 2020 was kind of not 2020, pardon me, April of 2000, sorry. That was kind of the end of the bubble, but it ended in biotechs. The NASDAQ biotech index, just people had kind of given up on the AOLs and Amazons of the world. And then there was just this incredible influx into biotechs. I don't know why. And that was the end of the bubble. That was mania. I don't think anyone really thought that because of the internet, there would be more pharmaceuticals produced. So I don't know where we are in manias anymore. What is the last leg? Like, are we going to go back and think, well, shit, they were kind of right about Amazon. I mean, really early. Like, are we going to say that? Or are we going to say what we said about the biotechs? That was total and utter garbage. Total and utter bullshit. I don't know. My personal belief about ChatGPT, large language models in general, is that I think it will have a profound impact on business in the next 18 to 2 years. That doesn't mean I think NVIDIA is worth 197 times earnings. I didn't say that. I'm saying they will have a profound impact on business, and businesses that are not almost urgently integrating it into what they're doing are opening the door for someone to take their business. I think it's urgent. I think it's urgent in my business. I think it's urgent in almost all other businesses, certainly software businesses. And if companies aren't focused on the things that are extraordinary about this, someone's going to take their business. And if it's in the world of finance, I'm looking for it. I'm looking to take your business. So I will say that. Now, does that mean stocks should go up 197% in a day? Yeah, I didn't say that.
For those who want to track more of your thoughts or work in general, outside of Twitter, where would you point them to?
So if you're into options trading, we have a product called Trade Machine where you'll find all of my it's a platform which allows you to backtest various strategies, through various vol regimes. We've introduced some of the best research I think I've ever done in a measure that I use for kurtosis and skew for returns. So looking at return distribution characteristics, both right side and left side. And it's had a profound impact on returns. This is one of the best times ever to be like in that community. Now on the more like conversation stuff we're talking about, economics, AI, and stocks, then we have a product called CML Pro, which is just a subscription where it's kind of these conversations. So it's two sides. The option trading thing is called Trade Machine. The kind of intellectual conversations talking about stock research. I'm an analyst of record for some companies like Datadog. That's CML Pro. So that's our two products. The company I run is called Capital Market Laboratories. So there is a site, capitalmarketlabs.com, and it kind of explains everything I just said.
Good place to wrap this Twitter space up. Everybody, please make sure you follow Ophir. I very much enjoyed this conversation. Just the whole blocking and mute thing was phenomenal for me as somebody who's so loud about that. So everybody, please make sure you follow Ophir, and hopefully I will see you all soon. Thank you, Ophir. I appreciate it.
Thank you, Michael. It was a great pleasure. Thank you.